All right, everybody, we are here. We are live. It is 11 p.m. Past few days I've been coming around 10:55 just to vibe with you guys, but I was a little late today. So if you're on the FYP, get your butt in here. Yap King, welcome. Just gonna give this a little bit of time for the regulars to come in and come through. Jap King, thank you for the live. Hey Sam, welcome. Lucy, you're welcome. Inner Truth, welcome. Lovely to have you here. Faisal, board 007, welcome. Hi Inner Truth. I hope you had a wonderful day. Stand Strong, you're welcome to the live. Joshua Itusi, you're welcome. Lasco Angari, you're welcome. Inner Truth, thank you so much. Always good to see you. Jap King, you're trying to learn, but you can't find any credible sources. Start from babypips.com. Stand strong. Good evening. I hope you had a wonderful day. Start from babypips.com, Jap King. Start with your school. It's free. It's completely free of charge. I like to send complete newbies there because I need to be sure you're actually going to commit. Some people think they want to learn Forex, but then they start and they realize, not really, which is not a bad thing, okay? So just go and check it out. Hey, Jap King, thank you. I appreciate the follow. Thank you so much. Appreciate you. All right, just Amin, welcome. I'm seeing familiar people here. I think there's enough of us. All right. I'm just going to get started because it is 11:01. And as usual, we'll start from the very beginning. For the benefit of those who have not been on my live before, everything I talk about is basically rooted in the concept of liquidity. So I explain what liquidity is. Moel, good evening. I explain what liquidity is, and it does not mean that you should change your strategy, okay? You do not have to change your trading strategy. When I show you what I'm going to show you, you can still implement your trading strategy. What you're going to find, though, is that it'll be more accurate, okay? You will have much better placements for your entries, your exits, and you'll also know, like, when to get out of a trade on time, when to get in, when you might be wrong or right. Jack King, thank you very much. While I have you guys here in the beginning, I want to say this. I will be alternating between me speaking like this with this accent and then me speaking in a Nigerian accent with pidgin. Anybody who has a problem with it, please come on the day that you prefer. If you prefer pidgin, come that day. If you prefer English, come the next day. So assume that tomorrow's live is going to be in pidgin. Okay? Anybody has a problem with it? I don't know what to tell you. The next thing I want to say is everything I'm sharing here is absolutely free of charge. The only thing I ever charge for is a one-on-one mentorship, and even that I'm not really keen on, which is why I have a very limited slot for just 5 people. And that is why I do this for free. I give my time for free, like over an hour plus every day. So if I'm doing that, I think that's more than enough. Anything else anybody wants one-on-one, yeah. You can come join the Telegram, which is linked in my bio. Go ahead and join. Check it out. We have conversations about price. You can ask questions. But I beg you, I do not want people who are lazy thinkers. I don't appreciate that. You don't expect me to spoon feed you everything. So pay attention to the lives. Pay attention. I repeat the same thing every day in different ways because repetition is how it sinks in your spirit and you start to act on what you've learned, okay? So just pay attention. Always do your homework and don't accept everything I say. Don't accept everything I say. Go back and prove it to yourself first. All right, with that out of the way, let's talk about it. So, as I always say at the start of every live, your job as a trader is to deal with money. So let me get this. Let me get my text box ready. Give me a minute. Text. All right. Come on now. Thanks. Let's stretch this up. Give me a sec while I set this properly. I want it to be large enough for you to see. All right, so your job as a trader. If you know your job as a trader, it is difficult for you to stray from your trading plan. Once you know what it is you're supposed to do every day, it is hard for you to stray from your trading plan. So what exactly is your job as a trader? Your job as a trader is to ask yourself 3 questions. Ask yourself 3 questions. Those of you who know me already, you know what the questions are. Number 1, where's the money coming from? 2, where's the money going to? And 3, Is there enough room between both places for me to take some for myself? Right. Why are we talking about money in the first place? So when it comes to trading, in my opinion, okay, my personal opinion, my experience, having traded for 10 years, having lost for 9 of those 10 years before finally finding profitability, my opinion is this: everything you're doing starts and ends with liquidity. This is a concept that I learned from Michael Huddleston, who is also called the inner circle trader. Whatever your sentiments may be about the guy, I advise you to please set your ego aside and set that aside as well. And remember that even a broken clock is right at least twice in a day, okay? In other words, forget about the person and focus on the content. Is it true? Go test it for yourself. So everything starts and ends with liquidity. But what exactly is liquidity? Liquidity is money, okay? So this money that we're wondering about, that is exactly what liquidity is. Every time you hear that term, you don't have to be afraid of it. Don't feel daunted every time you see a YouTube video that you'd have liked to watch, but then you see, oh my God, the word liquidity, such a very huge financial word, probably not going to understand the strategy. No, you will get it. Just replace the word money in your head and you'll be fine. So we have to ask the question, where's the money coming from and where's the money going to? Because there's something I always say. Look at this chart. There's so many things you could look for. There's so many things you could attack or target or whatever. The problem with trying to trade with no specific context in mind, and that is what these questions provide for you. Like, they're like a context framework for you to understand where to get in and where to get out. The problem with too much freedom, or rather with complete freedom, unrestricted freedom without structure, is that it leads to complete destruction. Freedom is lovely, but there must be certain limitations for you to enjoy freedom to the max. Let me explain. So you're looking at all of this, you're probably confused. But then when you grab 2 price points, okay? I'm going to draw them here. Where's my horizontal line? There it is. When you draw 2 price points like such, and you tell yourself, I'm only looking at the price action that is happening within this range and maybe just a little bit outside of it. Guess what you've done? You've made it very obvious to yourself if you are wrong about let's say you're planning to buy, and the market breaks down and starts going against you, then you know you were wrong about that. Let's say you're planning to sell, and the market starts to go up. You know you're wrong about that immediately. You now have the option of either waiting for the market to break back in and for you to take a trade in the original sell you were planning to, or for it to break back from the bottom in for you to buy. That's one option. Or you could say to yourself, well, it didn't do what I expected it to do, and so guess what? I'm going to leave it alone. And that's how you save yourself money. So what exactly are these 2 random lines that I have put on my chart? The space between these 2 lines is the range. So I define a range as the difference between 2 price points. I do not care if you've always thought that a range is only, Asian session range, London session, New York session range, or the daily range. No. I also don't care if there's only 1 pip's worth of difference between these 2 lines. A range will always be, for me, the difference between 2 price points, the area between those 2 price points. The problem now is there's only so much you can do when that area is too small, which is why we have that third question. Is there enough room between where the money's coming from and where it's going to for me to take some for myself? So how do you know exactly where the money's coming from in the first place, where it's going to, and if there's enough room? You need a range. Okay, let me show you different candlesticks here. So this is a 100 pip range bar chart. I'll take you to a regular time frame, let's say 1 hour. This is the Aussie dollar, AUD USD, for those of you who are new. This is AUD USD on the 1 hour chart, which means that each of these candlesticks here shows you all of the price action that took place within a 1 hour interval. All right? So as soon as an hour is over, the next hour a new candle opens, etc. Every candlestick has 4 price points. Well, most candlesticks anyway. You have, in this case, this is a bearish candle. You have your open, you have your high, you have your low, and you have the close. This is a bullish candle. You have your open, you have your high, you have your low, you have your close here. Okay? A range already exists. If you want to use opens and closes, that's up to you. I do not. What I like to use is the highs and lows. Okay? So why am I telling you this? Depending on the pair you are trading and the time frame you are trading, you can take a single candlestick and use that as the context for your trades. So let me take you to a daily chart just to show you a clear example. Look at this lovely one here. All right? This is a high and this is a low, right? This is where this candle closed. Then this one opened, and what happened? It started to push up. If it's pushing up like this, and I can already see there's a selling pressure. Not only is there selling pressure, there was money here, and I will explain why in a bit. Give me a few. There was money here. It's been taken. So if the money's been taken at the high, I expect them to push down to the low. And now I have this wonderful opportunity where the market is pulling back into this bar here. Guess what? I'm framing my trades with this range. So if it pushes down here, I have no business with it. But if it's pulling back up into the range, great. That's a pullback that I may be able to exploit, if that makes sense. So I could be looking for sells within here. Or I could, since I have this boxed off, and I'll just box it off so there's no confusion, here and here. If the market travels far down south, I could say to myself, I'm not interested as long as it's outside of here. When it comes back in here, then I can start saying to myself, aha, now I'm going to go down to a lower time frame and start looking for reasons to buy. Why would I buy here? There's something, I might as well talk about it now, called PDA, and it's not public displays of affection. It's the premium discount array. Give me a sec. Let me write it out so that everybody knows exactly what it is. In there are 3 things you must know. Number 1, no, this is not bold enough. Excuse me. Change that to, let's say, 16. Boom, and make it bolder. Thank you. Number 1, you have the equilibrium. These are all relative to the range. Number 2, you have premium. Number 3, you have discount. Okay? So let's talk about these 3 things relative to this daily candle on the Aussie dollar, AUD USD. Whenever you have your range, which remember we've said is the difference between 2 price points, or if you don't like the word difference, the area between 2 different price points. And these 2 price points that I have drawn here, let me make this a little clearer for you so you can see where are we. Let's make that a little more. Yeah. So this area here is an entire range. It's a day's range, 1 daily bar. Now, 50% of that, the 50% level, is what is referred to as equilibrium. Equilibrium is a fancy word for balance. What it means is there's equal amounts of buying and selling, everyone's settled, but it also means anything can happen. So we could come here, it could take off, it could pull back, whatever. That's not what you're interested in. What you want to see in this particular case, since you're trying to sell, is this. You want to see the price come above that 50%. All the prices that are from that area above 50%, that is called the premium range. That's the premium portion of the range. Those are premium prices. You are looking to sell the premium portion of a range, and get this, in the context of a downtrend, or in the context of a high time frame retracement. What do I mean by retracement? So let's pull back a little bit, right? Notice how, this is not the best example, but we'll go with it anyway. Notice how the price goes up and then down, up and then down, up and then down. So the push is to the upside because we've actually been journeying up for quite a while, as you can see. It's been quite a while since we've been pushing to the upside. The pushes to the upside, those are the actual impulse moves. The ones that bring the price back, that's the retracement. So the only time I would encourage you, or not encourage you, but the only time I might say, okay, you can sell when you see that you are in an uptrend is when you've confirmed that there is a retracement in play. All right? So in that situation, you sell. You grab your range, first of all, whatever that is to you. There are many ways you can define the range, and you learn that in this session. You mark the 50% area, go up a little bit, and set an alert there. Once the price is hit, then you're just going to look for reasons on a lower time frame to get into a sell trade. The portion below the 50% level is called the discount. So you want to buy when you are within discount, okay? Because discount prices are cheaper. Excuse me for a minute. I have to turn my DND on. Don't need this distraction right now. Awesome. So you buy when you're in a discount, especially when the trend is up, okay? If you're going to buy in a downtrend, make sure that buy trade is based on a higher time frame retracement, and have it in the back of your mind that at any point in time, the market could flip the other way. Why? Because every single time frame from M1, M5, M15, M30, H1 sometimes, they all answer to H4, the daily, the weekly, the monthly, and so on. The higher time frames are the ones that dictate what goes on the lower time frame. Okay, so don't think to yourself that you might be able to catch the ultimate low of a move, and it's not going to be based on a high time frame premise. It has to be. So you now know about the three key areas of a range, any range, okay? It could be a daily candle, it could be a range bar chart. We'll talk about that later. Now, let's come back to what we were discussing earlier. Let's see, where was I? Was I over here? I had notes and now I cannot find them. What's going on? Yeah. Okay, I see why I couldn't find them. So your job as a trader, let's revisit those three questions once more. If you missed it, here we are. Your job as a trader is to ask yourself three questions. If you ask these three questions every day, what you will notice is you're no longer in a hurry to get into trades, and you stop entering stupid trades that don't make sense. I'm not judging you. I've done that before multiple times. It's not judgment, it's an observation. I would not be able to teach about it if I've not blown many accounts myself. So you're asking, where is the money coming from? There are two different kinds of liquidity you need to know about to be able to answer these questions even more accurately, right? Because you could just draw a range based on anything and then play around with that. But we're going to get even more granular with this. So there are two kinds of liquidity, which, as we've said before, liquidity is just another word for money. There's two kinds of liquidity you want to look for in general. So number one, you have external range liquidity. Okay? So think of this as money outside the range. Let me write that out. Number two, you have internal range liquidity, which is money inside the range, right? Now, let's address external range liquidity first. External range liquidity basically exists at highs and lows of the ranges. That's all. All right? So if I want to split that into two, maybe whatever, but it's just basically highs and lows. That's where the external liquidity is. And I'll show you a few examples. So you could look for highs and lows by scrunching up your charts really tightly like this, and then looking for those sharp areas where the market reversed away from. Then you mark it and you're like, yeah, let's set an alert here and see what happens when the market gets here. Let's set an alert here and see what happens when the market gets here. Let's et cetera, et cetera. Okay, you could do that. Or you could pick a single bar. Look at this beautiful instance. This is AUD/USD. This is the 100 pip range bar chart. Notice we've been pushing to the upside for a while. Each of these bars is worth 100 pips of movement. This particular bar chart, it does not create new candlesticks based on time. So even if it takes 5 days or 10 days for the price to move 100 pips from the low in the case of a bullish candle, or 100 pips from a high for a bearish one, then it will not print anything for those 5 or 10 days. It doesn't give a fuck about the rest of us. It will not print anything. And the upside to this is it makes your charts look cleaner. It makes it easier for you to analyze. So notice we've been pushing upward. Okay? And whatever downward movement we've had here has nothing on this move. So maybe, just maybe, we still have an uptrend in play. Why am I saying maybe? I need you to know right away, if nobody has told you this before, nothing in trading is 100% guaranteed. There is no such thing as a no-lose strategy. You will have losing trades, and it is fine. You have to wrap your head around that so that you do not begin to internalize your losses. We'll talk about that more in the weekend, during the weekend. But right now, what we have is this. We know that we're in an uptrend, and then suddenly we have this one candle here that is closing to the downside. So I'll just mark the high and I'll mark the low. And what I'm asking you to do for me is pretend briefly that this candle here and this one currently forming, they're not on the chart. So let me set this to something that makes it easier for you to see. One sec. Come here. No, you're doing too much. Yeah, that's okay. So I'm going to lock this so we don't lose our place, okay? Pay attention. This is a bearish bar that has occurred in a bullish trend. What did we talk about before? Just minutes before now, we talked about the concept of retracement. Okay, so this is a retracement, one that tells you, maybe I should look for a possible opportunity to buy. This is a good example because I need you to see good examples because I'm training your mind for that. But always keep in mind there is a possibility that the market could have done this and then just continued down. So how do you ensure that you're not trapped in a move that you're not expecting? Well, we go down to a regular lower time frame. So since this is 100 pips, let me start from the hourly chart and see where we can get some clarity. So this is the hourly chart over here. Let's see if I can zoom in a little bit more. All right. See this particular spot here where my cursor is? That is the exact area where that 100 pip range bar chart closed. That is the close price, the bottom of this rectangle, like so. All right. Now, what happens next? We're talking about liquidity. The money is resting outside of the range. One of the things you can do is decide that if you are going to trade from within the range, that's all you're going to do. You're not going to look for setups outside the range, but that's an option too, right? So this is the range here. The liquidity was definitely here because it poked past here. And notice, you see these wicks? Wicks are often a sign of exhaustion. Exhaustion from who? The sellers. Or if you don't believe it's actually sellers and you think it's algorithms, no problem. Exhaustion from selling pressure. The selling pressure is weakening. So the wicks are trying to push through, but they're failing. So let's take a look at what each candle is telling us here. See this one? First of all, we were pushing down strongly. Then this one opened. It tried to push down, but it wasn't happening. The market pushed back up and closed. Why? Because it's rejecting money here. What do I mean by money? The money that is there is your stop losses. The money that is there is all the people who are saying as well that, oh, they would like to buy that level for whatever reason and they have their stops too tight here. The money that is there is also the people who are saying, you know what, once this level breaks, I want to be a seller. The breakout traders who don't wait for confirmation, they just like go, boom. That's what this is just coming here to pick. Same thing here. What do we have? This candle opens, pushes up for a bit, and then comes down, boom. But interestingly enough, for all of this selling pressure, it still could not close beyond this candle's open here. This is where open and close prices can become significant. Note that those of you who've been here for a while, I have not said that before. This is where opens and closes can become significant. No co-hosting right now, please just focus. This is where opens and closes become significant. So look here, this particular bar is so bearish. So you think that it should break past here, but it doesn't. Even if the wick is very tiny, it does not disrespect this level here. Same thing with this candle. Let me zoom in closer so you can see. It opens, it pushes up, it pushes down, it comes back and closes here, leaving behind this wick. Notice how they're all maintaining this level. This candle opens here, pushes down, pushes up, and then closes here. Look at this one, also respecting that. Even when this guy comes through and sure, pushes down a little bit, but it's not really enough. Okay? These wicks, they can be a sign to you that there's a possibility We're dipping into external liquidity. And the thing you should know about any range you set, whether it's based on session highs and lows, daily highs and lows, H4 highs and lows, whatever you want, if the odds are high that if they come and take the top side liquidity first, which I mean, like, let's say this is a range now, if they come for the highs here and it's not planning to actually continue, the odds are high that they'll take it down. So if the high is taken first, then it's going down. If the low is taken first, then it's going up. This is a probable thing, please, ladies and gentlemen. There is no such thing as certainty in trading. You are playing a game of probabilities. You are here to exploit probability. Look up the word probability. It has nothing to do with certainty. It is the complete antithesis of certainty. So anybody who's trying to market to you that they have the sauce that will give you zero losing trades, run away. So this is external liquidity on the outside. Let's see over here as well, the same range here, because remember on that 100 pip range bar chart, remember the market kept going back and forth, back and forth. You saw the bars going back and forth. This is all of that price action now on a 1 hour chart. And this is AUD USD for those of you who are coming here. See, notice that same wicking action. Notice how it's difficult once the market breaks through like this and starts coming back here. It just has a really hard time getting through this area there. All that wickage. But you're not just going to use wicks to get in. We'll talk about how you get in later. So I have just shown you external liquidity. Now we're going to talk about internal liquidity. For that, I have to find those notes. Where did I put them? Let's scrunch up these charts. Actually, I have to go back to the 100 pip range bar. Give me a second. Loading and boom. So the next thing you must ask yourself, I'm going to delete this. Hopefully you've taken notes on that. The next thing you have to ask yourself is, okay, what is internal range liquidity? Money inside the range. Gorgeous. How do you recognize it? There are several different kinds of internal range liquidity. Deliberately, every live, I focus only on two. Because the last thing you need is to know so much that you are paralyzed when you come to the charts and you don't know what to do or how to act. So this is why, if you're an ICT person, that's cool, that's awesome. But this is why, for the people who are new, especially to this concept, I focus on the primary stuff, which is number one, order blocks, which can be bullish or bearish. And number two, fair value gaps. So we're going to talk about order blocks first. Let me move this out of the way. Okay, remember this range of ours over here? This down bar that I have marked out like so, from the high to the low. Remember I said, indulge me for a bit and pretend 1, 2, 3 hasn't happened yet. So now what I'm going to do is head back down to a lower time frame. So I call these range bar charts, when I'm here, I call them range frames. What I mean by range frames, I mean you get to select if you want to work with a range bar chart where every bar is worth 100 pips or 50 pips or even 5 pips. That's entirely up to you if you're a scalper or something, right? So we go from a high range frame or a high time frame. This is not a time frame, this is a range frame, down to a lower chart. So I'm dropping now to the 1 hour chart. Okay? Remember, this level here, I need to scrunch this so you can see. It's a little too scrunched for me though. All right, cool. Remember this level here? That is exactly where that bar closed. Excuse me, let me sip something. All right, I'm back. So let's talk about internal range liquidity. For internal range liquidity, we're talking about the order blocks first. For an order block, what you're looking for is a high to get broken by the price. Once this high over here is broken, and why do we call it a high? This is a high, this is a high, this is a lower high than this one. You're looking for the most recent high to get broken. What do I mean by broken? If you're on a lower time frame than the 4 hour or the 1 hour, depending on what you're trading, and you see only a wick pass through here, I do not count a wick on a low time frame as a break. I personally don't. But if I'm on a high time frame and it's just a wick, I can count that. Okay? Because remember, the high time frames are more significant, and that wick on a high time frame would be an actual break and close on a lower time frame. Note that. So you're waiting for this high to get broken. As soon as it is broken with a close, the candle must close, please. If you wait and then you're noticing the price is now moving through here and you're in a hurry to get into a trade, there is a possibility that the market could just do this. It could go down and wick you out. So wait for the actual close. Once this has closed above here, you now have your order block, which is technically the last bearish candle that led to the move, the push move, the impulse move that broke this high. If you have, as in this case, a doji, my advice to you is to always make sure that you mark the other candle before it as well. That's condition number one, because a doji to me is not significant enough to count as an order block by itself. That's just me, because price can do weird things around it. The next thing I want to point out is this. Even if this weren't a doji, let's say it was a regular red bar, bearish bar, if you notice, just like in this instance, the one before it is also bearish, the one before is also bearish as well, you can go ahead and mark the entire series. Let me grab a rectangle. Change that color, please. You can mark the entire thing. Some people will mark the entire thing from wick, the top wick here to down here. But some may come here and just put it to the body here, and then all the way down. The choice is entirely up to you. The whole idea behind the order block is that the big boys and big girls, or the big bucks who trade, who actually move the markets for us peasants to take advantage of, they can't put in all of their orders at once, because if they did so, it would cause some very dramatic instability. Maybe things would like take off all at once, right? So what they do is they have this, and then they'll come back later to fill in the rest of their orders before the market takes off from that point. So your job is just to wait for it to come in. And I know in this particular instance that did not happen, but I will show you order blocks that actually work out. So this is a bullish order block. You can stretch that out and see if there'll be some sort of reaction to it in the future. I personally prefer to trade with as recent price action that's as recent as possible. So let me show you another example of an order block here. We have this high, 1, 2, 3, which is a swing high, okay? A swing is a turning point in price. It is literally the point where the market was pushing one direction and then it turns. That turn could be for just a retracement, as it was in this case, or it could be a full-on reversal, right? This is a swing high. A swing low is different. A swing low, so for a swing high, you'd notice that the high in the middle bar, is higher than the other two on either side, okay? And for a swing low, you notice that the low in the middle is lower than the candles on either side, the lows of the candles on either side. And if you remember that price is fractal, meaning what's taking place in a higher time frame is taking place in a lower time frame, and you can stretch that out in your mind, you will soon recognize that this pattern here is that inverse head and shoulders that you learned about on Baby Pips or something, right? And this is basically that head and shoulders thing as well, if you check it on a lower time frame. But that's just something to keep in mind as a side. Look here, this high gets broken. Once it gets broken, what do we have here? The last bearish candle that led to the move. Remember I said if you have a doji, instead of a full-bodied candle, or a candle with more body, basically, more junk in the trunk, what do? You make sure, oh dear, no, get off. I just need this guy. Thank you. You make sure that you highlight not just this bar. Let me zoom in because I feel like it's getting difficult to see, and I'm going to change that to a different color, please. Thanks. Okay, so you're highlighting not just this bar. You're going to take it, and this is not a perfect example. I feel like it's going to confuse you. But you could look at this bar instead because it has actual body, and notice that the market taps into it here and takes off. Okay, let's look for more examples of bullish fair value gaps. I crave your indulgence. I'm going to delete this so that it makes it easier for me to scroll. Well, there was two of that. It explains that noise there. Okay, so look at this example here. This is a high. It gets broken by this candle. Once that happens, we're asking what's the last bearish candle that led to that move? This guy here. So remember I said some people will just mark the body. You notice how there's one and two of them? Maybe you want to drag it up there, or you want to just address the wicks. Whatever, that's up to you. If you use the wicks, look at the fact that this guy tapped into that order block and then took off from there. Okay? And this is something that repeats itself. Not every order block will get mitigated or taken immediately. Keep that in mind. So if it doesn't come back, it doesn't come back. Go look for another setup on a different pair. It's not the end of the world. So those are order blocks. Those are bullish order blocks. I'll show you bearish examples as well, and then we can move on to the other kind of internal range liquidity. Excuse me. All right, so let's talk about bearish order blocks. In this case, you have this low here. This low gets broken by these series of candles. What is the last bullish candle that led to that move? It's this guy. And then what happened? The market eventually pulled back up into this guy. Remember what we talked about with wicks? Remember how we defined the swing as the literal turning point of price. 1, 2, 3. Notice how the market never revisited this high. So you could have entered with a swing rejection if that's what you wanted, or you could have had a pending order here. A sell limit, your stop loss above, and there you go. So this is an example of a bearish order block. Let's look for another clear one. Your assignment, should you choose to accept it, is to go and look at your own charts and try to spot this for yourself. So look at this here. Now, this is a tricky one. Sometimes there will be a break, but you don't realize it's a break because you're focusing on highs and lows. Okay, that was one thing that I used to do. It took me a while, then I started getting more experience, and I realized sometimes you don't realize there's actually been a break. Look at these levels here. Notice how the open, the close, the open of these three bars, even this one here, they're all kind of on the same line. Then notice what this candlestick does. Not only does it engulf this candle, it breaks this level here. If I switch to a line chart, let me switch. Is it Alt? Yeah. If I switch to a line chart like this, look at that. This is that level here, and it got broken. Okay? So that's what you're seeing here. Once this break happens, the last bullish candle, that's your order block. Some people will go ahead and mark this as well because it's 2 consecutive bullish candles. That is entirely up to you. That is a bearish order block. Bearish because you're going to wait for the price to retrace into it and then you're going to sell. All right? So now that we have that out of the way, let's talk about fair value gaps. I'm looking at one right now and I'm going to show you exactly what it is. For a fair value gap, the first thing you're looking for, see this high? It gets broken by this candle. Once it gets broken with a close here, you notice that there was this gap between this high here, this wick, and this wick here. This gap is the fair value gap. And the whole idea is there's also money resting here. So how do you get in? You can have your pending order here, your buy limit, so that when the market starts to retrace in here, it picks you up and then it takes you with it. You can have your stop loss at the lowest low, or if this candle, because sometimes it doesn't play out like this, I'll show you a different example of a fair value gap in a bit. Sometimes this candle will not be the lowest low. Whatever the low is, just put your stop loss below that. This is one example. Let me show you another one, okay? This one's going to be really tight. I'm going to take this off. Craven, your indulgence, give me a sec, because I need you to see it. Look at this high here. Notice this candle breaks and closes above like that. Boom. Once it breaks and closes, now this is the typical fair value gap that you can look for. Although after a while you'll be able to spot stuff like the first one I showed you. But for the basics, for starters, I should have shown you this one first. You have this high. The high gets broken. You wait for the next candlestick as well to close. And what you're looking for is you want to see if there is room between this wick here and this wick here. Oh, come on. I don't know why this thing keeps snapping. It's so annoying. So let me draw this out for you so you can see it. It's really tiny on this chart, but it's there. Okay, this is a high. It gets broken. Once it gets broken, you're waiting for the next candlestick to close. And then you're looking to see if there was room between, in the case of a bullish fair value gap, between the low of this wick here, the wick of the candle after the one that broke the high, and then the high of the candle that got broken. Do you understand? So you have a high. The first thing you're looking for is you have a high. You're waiting for the high to get broken. It gets broken, great. What's the next thing you do? Wait for the next bar to finish, and it must close. Once it closes, you're looking at the low of that candle, and you're checking out the low of that candle, skipping one candle, and then looking at the other one here, noticing the high. And then you're asking yourself, is there room between the two of them? Or are they touching? Are they overlapping? They are not. There's no overlap here. What is here is just this strong bullish push. That is an imbalance, and the market needs to rebalance it. So what does it do? It comes back into it. Notice how perfectly it taps into here and then takes off. So that is another example of a fair value gap. I'll show you another one. Multiple, actually. We have this high. This candle breaks that high. And then this other candle here is formed. What does it leave behind? You've got this fair value gap here. And yes, I know you're already seeing it. You can see this as well. When you have a situation like this, it is possible for you to get in a trade here and have it take off. However, it is advisable that you wait for this one to get tagged. Or if you are in a hurry, which why would you be in a hurry? There's so many opportunities. But if you insist, you can have a pending order here, but make sure your stop loss is as far back as here. Because in this example, you can see that would have taken you out if you were trying to just do the thing of, oh, I'm going to have my stop here, just my stop. No. There's two of these guys. Sometimes the market will just take that one and leave the other guy. But now in this case, it did this. And that's why if you're going to do this, you notice multiple fair value gaps. My preference is come to the lower one in case of a buy. If it was a sell, I'd be like, come to the higher one or leave me alone. I guess you're not my trade. All right? I'm not in a hurry to make money. That's the attitude, and that's how you make money. So you now know what a bullish fair value gap is. Let's talk about what a bearish fair value gap is. This is an example here. Maybe not the best one. I need something newbie friendly. So let me go to a different chart. Let's do USD CHF. I will come back to AUD because my notes are there, but just give me a second. And I'll take you to the weekly chart. This was a trade I actually took the day before yesterday. Excuse me while I change the color so you can see better. And boom. Zooming in. What do we have here? A low. This low gets broken by this candle. Remember, guys, it is important for you to wait for the candle to close. This is a weekly bar, which means you're going to wait an entire week. Once this happens, the next candle closes as well, leaving behind what? Look at the wick here from before the candle that broke the low, and then look at the wick here from the candle that closed after the breaking one. You're just marking that space from that wick to this wick here. There was someone in the group, I hope he's here. Dollar, I really hope you're here, Dollar FX. This wick to this wick, you're marking all of that. All of this here is nothing but selling. It's imbalanced. There's too much selling and no buying. And so what needs to happen is the market has to come back and rebalance that. This is a fair value gap. So let's actually look at how you could have played that. I'll go down to the 4-hour chart. This is the gap here. all you're doing now, if you're paying attention, this is actually a range. Because what did I say a range was? The difference between two prices. You marked a high and a low. This is a range. What did I say about ranges? That you want to, if you are in a downtrend, you're looking to sell from the premium. Or if you are in a retracement on a high time frame, you're looking to sell from a premium. A retracement in a bullish trend, I mean. Now, what do we have here? The whole thing was, you can see for yourself, it's been pushing down, 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 down. This is that fair value gap which we marked on the weekly time frame. Notice what happened. It came to the 50% point, equilibrium. We talked about this. We know that the area from just above 50 to the top is your premium. That's your premium prices, right? So what can you do? You can look to the left and ask yourself, I just moved this a little bit, pardon me. You could look to the left and ask yourself, in all of this, what do I see in the premium section that could be something the price may respond to? We talked about this just now. We have a low, this low gets broken, or this low here, it gets broken by these series of prices. What are we seeing here? Order block. Awesome. So what do? You can select all of them if you want to, or you can go for the last one since this is a 4-hour chart, because that is pretty significant. So now I'm just marking the order block for this 4-hour chart like so. Then what? I'll go down to a lower time frame. There was always the option, if you put a pending order here and then the market comes back to this level later, notice what happened. This was that CPI, or what was it? What was that news release? Boom. For 100 pips in record time in a single 4-hour bar. All right? That's one option. Or you could have said to yourself, you know what? Let me go down to the hourly and see if I can refine this even further. And what do you see here? We have these series of bars. I can't really say there's a swing low per se that gets broken, even if I know from experience I could argue that this was the break. But let's go lower still to the 15-minute time frame. So let's say no further refining. I just left it as is. I need you to notice what happened here. Let's see if I can pull that up. 1, 2, 3. What did we call that? A swing high. What did we say about swings? A swing is a literal turning point in price. Now, please, this does not mean every time you see a swing, you should trade it. That swing must be tethered to the idea of liquidity. I had some character, I'm not going to name names, telling me that the people who are liking it, I did a video about swings and liquidity, high time frame swings, high time frame liquidity. And he was talking about the lack of critical thinking. And I'm like, well, that's sad because honestly, I should have said a lot more than I said in that video. You lack critical thinking if you're here. I'm here to tell you that. Because you can't just take any swing. I was not saying that. I was saying that you must pair the idea of swings with areas of liquidity, particularly high time frame areas of liquidity. That's where the concept becomes powerful. That's where it gives you stuff like this. That's where you get stuff like this. Where is my deal map? Well, it wasn't this particular account. Damn it. That's where you get stuff like this, 1, 2, 3. So if you just saw the swing and you said to yourself, I'm going to jump in, I'm going to have my stop loss here. Boom, look at that. Alternatively, as soon as you see the swing here, 1, 2, 3, let me show you how you could have refined that even further. Pay attention to this red line, okay? This is after the swing had formed. Let's go to the 1-minute chart and let me show you. Let's go back. Where is it? Yeah, over here. Now let me zoom in because I need you to see this for yourself. This is after that swing has formed. Notice you have a range. Let me explain. You have this high here, and then the market started to turn down. When the market got to this point, it started to turn back up. Once you have, the market is giving you one turning point where it's pushed away from. key where it has pushed away from, and then a second turning point where it has pushed away from. You can frame this high and this high as a range. So let me take this off so there's no confusion, and I'm going to put another rectangle here, changing the color so you can see. This is a high, this is a low. Let's pull it back. Remember, we haven't seen this until this red line here. Remember, we're looking to sell. Remember, you're looking to sell from premium prices, which is anything above 50% of the range. So this is where we are. All of this other stuff hasn't happened yet. So what are we doing now? We're just looking left and saying, what is the thing we can use? What is the internal liquidity that we can use to frame a trade? Well, what do you have here? This is a low, a swing low that gets broken. As soon as it's broken, this becomes your order block. So we move this up here and see for yourself. The distance from this point here, let me drag this properly. The distance from this point here to here is about like 4 pips. So let's say, depending on the spread that you're using your broker and all of that, let's say you had a 5 pip stop loss, okay? And then look at that. Because we went to the weekly. Because the market moves, the moves that you see on the weekly, if you see any kind of liquidity on the weekly, on the daily, on the higher time frames, they are super important. Because even if the market does not move for too much, like look at this single bar right here, from this high to this low, that's a whopping 164 pips, thereabouts. Let's say 150 pips. So it does not look like much. This is a weekly chart, but if I take you to maybe a 5-minute chart and we see a similar bar like that, we could just use any of these random ones here. It's just 3.6. Okay, you want to argue maybe it's market ends, whatever. Look at this one. It looks big, but it's just 10 pips. So if you go to a high time frame and you frame your trade, the argument for your trade, the case you make for why you want to sell or why you want to buy, if it is rooted on the concept of liquidity, particularly with the higher time frame, it will give you incredible results. I'm not saying you will not lose trades. You will lose trades occasionally. But when you do win, you will win big. That is the whole point. Okay? When you do win, you will win big. Now, you may be wondering, okay, we've talked about how you got into this trade in the first place, which is great. Well, genius, how do you get out? How do you know exactly where to get out? The same thing, liquidity. Where did I say liquidity rests? Highs and lows. So you're taking a sell. You're going to look for lows to target. What do you have here? This is a low, but not only is it a low, you have a fair value gap. So if you wanted to, you could have gotten in and you could have exited here. If you were not sure about that, or you're thinking, well, there may be room for the market to continue pushing, no problem. When it gets here, you set an alert for here. When the price gets here, maybe you take something off the table and move your stop to break even. That way you're completely detached from the trade. Whatever happens, happens. This is another area you could have taken money from, here and here. Why? There's this thing that happens where if you have, in this case, 2 lows, this low here has not tapped into this low. It's by design. Because what's happening is people are looking at this low and they're like, yeah, I'm going to put my stop here. And then they see this low come in here and it does not take that guy out and it continues up and it's like, yeah, great. Maybe I jump in again. I'll put my stop here. What they don't realize is these big boys and girls with the big bucks are actually doing something called engineering liquidity. Remember we said liquidity is a big, big fancy word for just money. So in other words, they know that you, I, and Uncle Joe have all been taught that we should place our stop losses at the lows when you're buying, at areas of support. And so you're convinced now that the market's not going to come tap this. But it's a trick. And then they come back and boom, look at that. Pure wickedness. Literally wickedness. So you could have taken, when you see, these are called relative lows. You also have the relative high version. When you see these lows like this, just assume there's a chance You notice the second low didn't take out this other one. There is a chance that they're coming back for it. It's a setup on purpose, trying to make you feel safe with your buys. Where else could you have exited? Notice you have this high here. It gets broken by this bar. When this bar closes, what do you have? Fair value gap. You want to be safe, not greedy. You can exit here. You don't have to wait for it to clear the entire gap, because sometimes, in fact, a lot of the times there have been instances where the market will just barely tap and take off again. So this is a better exit than here. Don't get greedy. Or if you want it to hold by force, okay, fine. Move your stop loss a bit more to secure something. So you see why liquidity is important. Now you're no longer wondering, where should I exit? Where should I enter? You know exactly where you should do what. And you know exactly when you are wrong, so you can get out. And if you pair that with a wider stop loss, which some of you don't want to do, that's fine. But if you pair that with a wide stop loss and you're willing to take regular, reasonable risk to reward ratios, 1 to 2s, 1 to 3s tops, I promise you, there is no way your account balance will not grow. I promise you, there is no way you will not pass your challenge unless you are leveraging, I don't know, if you're risking like 2% or 3% per trade. Calm down. They say you can pass it in 3 days, doesn't mean you should. That's a psychological thing. They plant that thought in your head and your body you start to get this thing like that Dave Chappelle skit where he has the white stuff on his mouth and you want to really, really get your next fix. And you start putting too much risk on. Okay? Just to look at another example, what do we have here? This is a high. So I'm doing this for the benefit of that one guy who was asking me, how do you take a fair value gap without an order block? It's not that deep, bro. Pick one. If you want to take FVGs instead of order blocks, then focus on FVGs. If you want to take order blocks instead of FVGs, no problem. But what I will tell you is this: if you see an order block and it happens to have an FVG following it, it just means that order block is very likely to play out in your favor. That's all. You want to do only one, pick one. There's no magic to it. This is a 1 hour chart, USD CHF, right? We have this fair value gap played out. I want to go to a lower time frame to see how we could have found a tighter entry. But if you wanted to, you could have simply put a pending order here, a pending buy limit, and then have your stop loss here or lower. And then it takes off. What do you target? It's very simple. What did I say? Liquidity rests in the range and outside of the range. What did I say again? You have this swing and then you have this swing where the market's pulling back. So your very obvious target is this high that was created. And this is a 1 hour chart, mind you. So if you see a setup like this on a daily chart, you already now automatically know how much you should hold for. On a daily chart, this could be worth hundreds of pips. And then you can have that one trade. You can become that one trader who does not trade every day because you're just waiting for that one yummy setup that sets you up for the week. Heck, probably even for the month. Because I feel like so many of us have forgotten the whole point of trading is not to take screenshots of our impressively tight stop losses and our impressive all blues and all greens, everything. You're doing this to live, to be free. You're not leaving your 9 to 5 to come to another 9 to 5. And then some people even make it worse. They're always at their laptops. No break, nothing. I'm sorry, I'm not that kind of teacher. I will not glamorize that for you. If you find that impressive, I promise I am not here to impress you. I'm here to disappoint you and hopefully disillusion you and help you see the truth. So we will not be doing that here. Okay? Break of a high. Boom. This candle closes. You have a fair value gap. Actually, my bad. This is supposed to be down here. Now let's go to a lower time frame and see what happened. I need this to mark this area here as the exact time we'll be looking at. So I'll go to the 5-minute chart first. This is a 5-minute chart. What happens? Remember, this fair value gap is a range. So there is internal range liquidity and there could be external. In this case, we didn't come to take that. So all you're asking yourself when we arrive here, this is where we're at. You're looking to the left and asking yourself, this is 50% of the range. This is the discount portion of the range. What in the discount portion of the range could I target? Well, what do we have here? One, two, three, swing high. Gets broken by this candle here, boom. This next candle forms, boom. What do you have here? A fair value gap. Did the market retrace into it or not? It absolutely did. Okay? If you did not want that entry or you wanted something tighter, no problem. Let's see what happened on the 1 minute chart. So remember, this red line is exactly where we come from. Now, typically for me, when I'm trading a 1 minute chart, in addition to looking to the left to look for possible areas of liquidity, this could be kind of confusing when you think about the fact that, oh, it's just all pushing to the upside. No problem. Another thing I like to do for 1 minute charts is this. We may tap into that level, but all I'm waiting for is I need to see you break a high. So we have this high, it pushes down like so. We have this one. What do we have? No break, nothing, nothing, nothing until this point here. We have this high, it gets broken, boom. What do we have here? This is a fair value gap. Do you see it? Let me zoom in. Fair value gap. Market retraces into it, and there's lots of wicks through it. So if you have a tight stop loss, this is why I like wide stop losses. If you have a tight stop loss, you're getting taken out. But if you must use a tight stop loss, no problem. Just drop your risk. Drop your risk. It is sexier to, let me put it this way. Consistency is sexier than that one trade where you made $1 bajillion. Do it multiple times. That's what's more impressive. So forget about trying to make it all in that first go. Every time you get in a trade, before you get into the trade, I need you to sit down and recognize it may lose. And then make peace with that. If you think about the fact that, oh, this trade may actually not work out, and you notice your heart is beating, your palms are sweaty, that's a sign. Drop your risk. Drop your risk to where you no longer feel that way. Let your body tell you what's going on. It's wise. In any case, if you got wicked out by all of that shit, you have another high here, another high here, another high here. This high gets broken. Right? Let me zoom in so we'll see exactly what took place. This high got broken by this guy. Is there a fair value gap? No, but there was this order block though. The market taps into it and takes off. And this is the other thing I need you to know, the importance of framing your trades. When you know where the market is headed, remember we said we're gunning for these highs. Okay, this is H1 now. No, this is M15, my bad. When you know where the market is heading, you can now add to your position as you get there. This is how you take one trade setup, which is just this H1. Let me go back to H1. This is M15. This H1 fair value gap. This is how you can take just one setup and turn it to something that really pays you handsomely. You know that you are coming for this high here. This high. Since you know that, and you are entering from here, on a 1 minute, on a 5 minute, on a 3 minute, I don't care, you will find multiple order blocks, multiple fair value gaps that you can get in. Some of them may wick you out. Doesn't matter. When they set up again, you take it. Just making sure you're not going crazy with the risk and making sure that the first trade you got into, the price is far away enough from it to be safe enough to move it to break even. So that if the market turns against you, you're not losing too much. This is how you turn a single setup into an opportunity that pays you over and over and over again. Beware, those of you who use prop firms, I know that some of them have this weird rule about how if you enter multiple trades in a single pair, they'll count that all to a specific lot size limit or whatever. I don't know, that's weirdness. But just keep that in mind. But I'm telling you, this is how you can take one setup and turn it into something that yields fruit. And then you don't want to touch your charts again. The less you trade, the better for you. What else have I not covered? Let's see. Let's just do a quick recap. So I think I started off with AUD and AUD USD. I need to go to... Oh, yeah. Before I recap, I want to show you one more thing. one more thing and then we'll call it GBP USD. Right. So I'm presently in a trade. That's what this is. And I'm going to show you how I got to this. First, I went to the monthly chart, and I'm going to take this off because it's in my way. Excuse me a second. Where is that? Positions. Cool. You can check the group so you know I'm not capping. The thing I said in there, I said, notice that this monthly bar, this is a monthly bar, this is the month of June. The low has just been tapped into. I sent that. So what do? Remember, every candlestick on its own can serve as a range. You can mark the high and the low, you can mark the open and the close, it's up to you. So let me change this to something you can see through. This is the entire month of June. We are currently still in July. This is the July candle, the red one forming. So what's the next thing that I did? Right? I went to the 4-hour chart and I noticed this movement here, that's that same CPI news thingy that came out. By the time I came into this trade, I think it was, oh shit, I shouldn't have moved that. Let me check again. I need to see the precise dot where I got in because I don't want to accidentally tell you something untrue. So you see this blue dot? I don't know if you can see, there's a dot right here. That's where my entry was. And I'm going to explain that entry to you. I saw this candle. Remember, we talked about the concept of liquidity and pairing that with high time frames. The same thing goes for your candlestick patterns. If you keep wondering why they don't work out, it's because you're not using them in conjunction with liquidity and high time frames. So we already know this is an area of liquidity because this is the previous month's low. And we know liquidity rests at highs and lows. And we've tapped into that. And what did I say? If we tap into the low, maybe we want to go to the high. And there is a chance, mind you, the market may not actually push all the way into last month's high. I'm willing to accept that, which is why my take profit is here. And I'll be monitoring it. And if I see that the market's turning around against me, I will happily close the trade. I've already taken some profits off the table, so that's not a problem for me. I don't care anymore. And the position size is too low for me to care. So let's talk about how I got into this. I hopped down from the 4-hour to the 15-minute chart. Let's take this off. What I saw here, actually, I have to take you back to the 4-hour, and I'm going to delete this because now you know it's the monthly range. What I saw on the 4-hour was this, before anything else. This bar here, I marked the high and the low. Let me change this to something transparent once more. This 4-hour bar, which engulfed this previous the candle before it, I marked the high and the low. And then I went down to the 15-minute. And all I was asking myself is, we are in the discount portion here. Right here. What is this? Break in structure, which made this what? An order block. Notice 1, 2, 3 swing. Notice that hasn't been touched or picked up per se. I entered and I just made sure my stop loss is kind of a little bit beyond here. You can see it for yourself. Look at that. I don't know if that dot is visible. I feel like I have to take you a little closer to see the dot. That's the entry. Okay? If you wanted to get it on a lower time frame, maybe you could have. I don't know. But my entry was, I used the 15-minute chart. Let's see what the 1 minute would have looked like. Yeah, actually, I remember this. So I'm going to delete this. I remember coming here and finding that 1, 2, 3 swing formation. Stop loss just below the swing. For how many pips? Let's see. 6. That's how straightforward trading can be. I went from the monthly. This is how I got this set up, from the monthly chart. And remember, I told you at the start of this, the range is the difference between two price points. And I've talked to you about premiums, discounts. Equilibrium can also be a target if you're using high time frames. You could use it as exit liquidity. You could use it as entry, although I don't really like entry because some weird stuff can happen there. But if it's a higher time frame, it could be just enough. Maybe you're just looking for 30 pips and that's all you want, no problem. Look at what the higher time frames are doing. They're doing stuff. That's what gives you that confidence to say, I'm going to ignore every setup that is going against that direction and see. Look here. This is the Aussie dollar. Let's see what's happening. This is the previous monthly candle. Okay? And look at this. They would call it a kangaroo tail. Some would say it's a hammer, whatever. But look at how powerful this move is to the upside. Okay? And let me zoom out. Look at these lows, these relative lows, all taken out. And then you have this move here. Swing. So all I'm thinking is I would like to keep buying or looking for opportunities to buy. This is AUD USD on the monthly. I would like to keep looking for opportunities to buy until somewhere around here. Why? Because when this low got broken, this bar became an order block. If a swing has formed, I can assume there is a chance that this order block here could be acting as a magnet for price. Does this mean the market will never push down? No, this is a monthly bar, which means there's so many things happening on the 4 hour, on the 1 hour, that could be a push to the downside that makes it seem like, oh, it's a downtrend, but it may not be that. And I may not even be right about this, but that's not the point. I've made an argument for it. So if I notice the market is now breaking above, then I know I was wrong. But the odds are very high because it's a monthly chart. If the market should come into this monthly order block, ain't no way. There will be some reaction, something. All right? So let's go to, from here, this is a monthly. Let's just make our way down and see what may be happening over here. This is a weekly chart now. What do we notice? We have all these wicks to the upside, but I like this bar. I like that it's high and it's low and compasses this one. It looks interesting. If you really look at it, it kind of feels like this. What did I say? I said on a higher time frame, if it wicks above it, I'm willing to consider the wick. If it's a low time frame, hell nah, I need to see a close. But this is a wick. So what am I looking at? Last bearish candle. This guy. Okay, maybe we can mark that. Let me get another square. Okay? Mark that out. No, that's not accurate. All right, cool. Mark that out. This is a weekly. Let's drop down to the daily and see what's going on. Fascinating. What do you have on the daily? We have all of this shit here. We have this high gets broken. It gets broken. We have this other fair value gap that you have here. What did the market do? It almost made it here the first time around, pushed up, and now it's come back here. This wick is not an accident. That's a buy you could have taken. Let's see. I didn't take it, but let's see how that could have played out. So this is a daily. Now I'm dropping down to the... Let's do... Hang on a sec. First things first. Refining the order block. So you know what it was on the weekly, and now on the daily, we're looking at this bar here. All right? Now let's go to maybe the 4-hour chart and see what's going on. Isn't that beautiful? Look at this. 1, 2, 3, swing rejection. The most beautiful swing you've ever seen. And then it's going up. This bar getting engulfed. Now, may it pull back a little bit from here? Possibly. This is, after all, a fair value gap, a bearish one. But remember, your premise is from a higher time frame. So even if it does pull back, personally, and this is not a signal for you, and if you take it as a signal, you only have yourself to blame if it works out or if it doesn't work out. I will not take credit for your winning or your losing. That's on you. So there is a possibility that it may pull back down again, but I would still be interested in buying, personally. unless I see something different. Like maybe the monthly chart in the next 2 weeks, it closes in a way that makes me say, probably not. Let's go down though and see how you could have traded the touch of this. So we'll go to a 15-minute chart. I'm going to take this off so I can scroll. Look here. What do we have? This high. Let me get this out of the way. This high. Okay? Was this? Let's see. Chart shot. What is this high? 0.64635, 0.64636. So that doesn't count. This high. What happens? The price wicks through it. Doesn't really give us much. Okay, no problem. But if you went to the 5-minute chart, see, this is the thing about studying and going from one time frame to another. Without going to the 5-minute chart, I'm following this. Look at this. Sometimes you don't really need to limit yourself to swings. You could be like a child. Do this. Pull back, drop, pull back, drop, push. That closed above there. If I go to a 5-minute chart, you'll see it. I can take you there. Let's go. And that's that break there. This. And then this candle forms. Now what do you have? A fair value gap. Let's change the color. Ooh. Here and here. The market pulls back into it. What do you have? 1, 2, 3. Beautiful. So you take swings that make sense. How do you know a swing makes sense? A swing is connected to an area of liquidity. How do you know you can trust an area of liquidity? Because you started working your way from the higher time frames and pushing down. So you could have had a pending order here with your stop below this second candle or below the swing. I don't like the second candle thing. I'd rather have it below the swing. This is the 5-minute chart, mind you. So you could have just had a pending order, or you could have waited for the swing formation 1, 2, 3. Okay, 1, 2, 3, I'm going to have my stop here. Or if you want to be safer, all the way over here. Now, for those of you who you love your tight stop losses, I've said something about swings before. I say when a swing really wants to move, typically, it will not disrespect the third candle. It will not disrespect this third candle. So when you have your 1, 2, 3, you could get in here, have your stop loss there, if you insist. If it disrespects it, maybe you could wait for the next swing formation. But there's always a chance that you may not like your entry on the next one. Alternatively, I'm going to show you something. 1, 2, 3, keep that in mind. What I'm going to do now is I'm going to mark the high and the low of this third candle. And we're going to leave this red line here because that's the start. I want to show you something. Let's go to the 1-minute chart. Hopefully it's a clear example of what I'd like to show you. Yes, it is. So this is after that swing formation. What do you have here? 1, 2, 3. Here, stop loss here. For 1.5 pips, this is AUD USD on my broker. The spread is usually no more than 0 to 1 point, not pip. So yeah, I wouldn't have gotten stopped out at all. But I don't trade this way anymore. I'm just doing this for those of you who like to be superheroes on the chart. But please reduce your risk if you insist on having tight stop losses. Barely 2 pips, and then you're off and running. And because you're working from a high time frame, you have more than enough room. Remember those questions we asked in the beginning. Where's the money coming from? Where's the money going to? And is there enough room? Okay, look at that. Where's the money coming from? Where's the money going to? Is there enough room between both places to take some for myself? Absolutely yes. Yes, there is, because you used a high time frame. And because there's room, if you wanted to, you could keep adding and adding to your position with the proviso that as you approach your exit point, okay, you get out. Don't hold for more. You don't need more. You don't need more. The less you trade, the better. I promise you. The less you trade, watch your win rate take off. And the best way to trade less, frame your trades on the high time frame. Be patient. Be a snob. The same attitude you would use to, you want to pick your favorite car or your favorite whatever, you don't do this, you don't eat this type of thing, whatever. Bring that to the charts here. I don't take trades that have no context. What is the context here? We're talking liquidity, we're talking trend, we're talking where's the money coming from and where's the money going to. If you cannot answer these two questions, where's the money coming from, where's the money going to, move to a different chart. When you are able to answer those questions, question number 3 as well, is there enough room between both places for me to take some for myself? If the answer is no, walk away. It's not for you. It's not for you. Leave it alone. Okay? So, there was one last point I wanted to make. I think I'll leave that for next session, actually. But yeah, anyway, before I leave you, I want you to really check out CTrader. I forgot to mention, I keep telling you guys to download CTrader and you keep saying you see plenty of them in the App Store and the Play Store or whatever. That's because different brokers have their own versions of CTrader. But the OG CTrader, if you don't want to sign up to any broker in particular, you can go to Spotware. That's SPOTWARE. Just look up Spotware CTrader and get it from the developers themselves. All right, they'll give you a free account so that you can look at these range bars. They're very, very great for trading. And I could give you, those of you that keep asking for strategy, I don't like to give strategy. I like to focus on liquidity, but if you must, no problem. So here's one for you. Take notes because I'm not going to repeat it. You have a range bar. This is a 100 pip range bar. Remember, whatever you pick, that's your choice. That's up to you. This would count to me as a high range frame. You have a range bar. You set your alerts. You find 50% of that range bar. Move a little bit lower than 50% and then set an alert. So let's have a line there. It should be a little bit lower than 50%. Then, when you get an alert that this has been hit, keep in mind this is a 100 pip range bar, which means you should be looking for, and some of you are not going to agree because you are greedy. No, Allah. You should be looking for anything, any point in time it could turn around. Because this time around, you're not using liquidity. You're not using the regular time frame. How do I put it? You're just using the range bar charts. So if you must gun for anything at all, you can gun for 100. But make sure by the time you're approaching 40 or 50 pips, you move that stop loss to break even. So thing number 1 is first, wait for a range bar to close. Second, set an alert at just below, in this case it's a bullish range bar, set an alert at just below the 50% in the discount area. Third, when that alert is hit, all you're doing next, let me drop a vertical line so we know where we are, is you're going down to a normal time frame. Maybe the 1 hour, maybe the 15 minute, that's up to you. Let me find, oh wow, that's going to be pretty far back. Yeah, here we are. Let me take it to the 15 minute then, that'll be better. Back. So you go to a low time frame. This is a 15-minute chart now. This is the point where you are. No, that's not true. So this is where, let me move away. This is where the 100 pip range bar forms. And then this is where you got your alerts, just below that 50%. And what do you see here already? You had this high get broken, and we're currently here. What is this? An order block. So you could have entered there. You enter there, you have a stop loss. Generally, give it some more room. Okay, in this case, if you zoom in a little closer, here you'll see that actually the market traded a little beyond there. No problem. But what did it trade into? There's another area of liquidity to concern yourself with. Look left. What do you have here? This break in structure, fair value gap. The gap is still there. It's not completely full. The gap is still there. Then you can go to a low time frame. I'm not going to do that because this is all the way in April and we'll be scrolling till infinity. No time. But you can go to from this 15-minute chart to a 1 minute and start looking for that break in structure, the order block, the fair value gap, whatever. Or get this, because you already know you are looking for buys and the market has come into a discount area, you can now start examining order blocks, sorry, fair value gaps and order blocks, but I'm not going to call this an order block, let me not confuse you. You can start examining fair value gaps like this one. Oh, but there was no break to the upside. Yeah, I know. But the point is, this is a trade that was framed on a high range frame, the 100 pip range bar. You're looking for buy setups. So you could have marked this out pending order stop loss here if you wanted to. Or you could go to a lower time frame, look for that tighter entry if you wanted to. And then the market pushes up here to the actual high of that range bar. You can exit there. No need to be greedy. If you went down to a low time frame, you're able to find some sort of order block or something that gave you like maybe a 5 pip or even a 3 or 2 pip stop loss, and you're making 50 pips. Come on now. Surely that's more than enough. Let's not be greedy. All right. So once again, it's Spotware, C-Trader, SPOTWARE. Go and check out their website. Download that version there. If you want to actually download one with an awesome broker that has tight spreads, it's just a recommendation. I obviously have no link to share, but you may want to check out IC Markets. They're really good. Their spreads are insane. If you like to trade pairs that have ridiculous amounts of volatility, like GBP CAD, GBP AUD, GBP NZD, etc., you'll be mad impressed. GBP CAD has a spread of just 1 point on a good day. I rarely ever see it go above that. And sometimes it will, but it still stays in the single digit range. It's not up to a pip, which means if you're a scalper, you will love it. Even if you're not a scalper, the fact that you can jump into a trade and be in profits almost immediately is stunning. It's beautiful. And some of you may relate to the frustration of getting wicked out of your trades because of high spreads. So IC Markets is awesome. Don't take my word for it. Check them out first on a demo before you go live. All right, that's about it, everyone. My name is Nessa. I am a Nigerian. Sometimes I will speak with an American accent, sometimes I will speak Nigerian, and sometimes I will just sound like a cuckoo, but it doesn't matter. I don't give a fuck no more. The point is, I'm here to teach you. I had 10 years trading experience, 9 of those years constantly losing after studying everything. And I promised myself that when I figure it out, I'm going to share and make it as simple as possible, and I'm going to do it for free. If you check the link in my bio, you will see the link to a Telegram group. There is no other Telegram group that I run. I will never DM you first, and I will never offer you a signal, because my thing is I want to get you to be able to think for yourself. And if I'm giving you signals, I am robbing you of the opportunity to grow confident in your abilities to do things for yourself. I will not do that to you. The time that I offer you is free. I come live every night, 11 p.m. UTC plus 1, which is Nigerian time. We don't have daylight savings, which means 11 p.m. UTC plus 1 is always 11 p.m. What else is there to say? In the Telegram group, there is a pinned message regarding mentorship. You do not need it. If you want it, that's fine. If you want it as well, I need to be very clear. The slots are very, very, very limited because I have other things I'm doing, right? I value my time. But I'm telling you, you don't need it, because if all you do is keep showing up for my lives every night, that is all you need. Weeknights, we talk about the charts. Weekends, we talk about psychology, your mentality, because some of you have been trading for years, and for some reason, you've been wondering why and how it is everyone else is using the same strategy and they're doing well, but you're still stuck. That's what we unpack during weekends. You will not find that interesting if you are a new trader, especially. You think it's all about strategy. You think it's all about money management. Someone DM'd me today and said, oh, the best way to deal with losses is to just manage your risk. And there is that. And I'm telling you that you can manage your risk. You could be very, very, very conservative with your risk, trading 0.1 per trade, and you will lose your entire account still. There are things beyond managing money and risk, and we talk about those things during the weekend. So come then, I adjure you. Those classes are usually, there's fewer people there, but that's fine. What else is there to say? Yeah, that's about it. I'll never DM you first. Oh yeah, the other thing, if you are DMing me on TikTok, I beg you, you keep sending me hi, hey, pretty lady, what's up? Who are you? Huh? I will not answer you. Sorry. I will not. I'm too old for that shit. If you want to send me a message with a trading related question or point, and I'm far more likely to respond. Okay? Let's be professional here. Let's not embarrass ourselves. I beg you. Enough. Enough. Come on. Please. Please, man. I want to believe in talking to grown men. Let's leave that small boy energy elsewhere. We don't do that. Because how you do anything is how you do everything. That's the energy you're using to approach me. Of course, motherfucker, that's why you keep losing. What? All right, so let me quickly get through your comments. Thank you for your presence. I appreciate you guys. You are amazing. You are amazing for giving me your time. And don't just take everything I say at face value, at jaw. I beg you. I want you to be very skeptical. I love me a skeptic. But don't be skeptical just to be a hater. Go to your charts and try to look for what I have shown you. Remember, for the umpteenth time, there is no such thing as certainty in trading. I will not sell it to you because I'm not interested. Everything I'm giving you already is for free and more than enough to help you make money. I'm not interested in that. There's no such thing as certainty. So if you go and you take one fucking trade, and then that one trade loses, and you come here and you're like, yeah, so I tried your strategy and it does not work. Are you serious? Anyway, let me come back here. Resilient. Go to babypips.com/learn. I like to send beginners there because it's kind of like a filter for me. If you go there and you spent like a couple weeks, maybe a month, then I'll know you're actually serious. And anyway, there's no need. Go there and then come to the live, and you can learn from here as well. You Learn Capital. I don't have a YouTube channel yet. Well, technically I do, but like there's nothing on there. Eric Martin, scalper analysis is the same thing. Price is price is price. The market is fractal. Price is fractal. Whatever's happening on a higher time frame is happening on a lower time frame. You can use the M15 chart as your version of a daily chart, your version of a weekly chart. And then you can go down to the 1 minute, 30 second, 5 second and look for your setups. They're the same thing. Please analyze gold. No, I don't do gold. It's the same thing though. I've checked. What I will say to you gold people is use H4. If you're going below H4, I think you're asking for trouble. H4, maybe H1, but please, H4. If you insist on H1, okay, happy compromise, use H2. Can you start with $100? 3A. If you are, if you're asking me that question, that tells me you're new actually. I advise you to not start with $100. I advise you to go and study and learn. Use a demo. Treat that demo as if it is live. Treat the demo as if it is live. Get used to it. It's free mentoring. The only thing that is free is the time that I give you freely, which is from 11 p.m. live daily on TikTok. If I cannot make it, I will post a video that I cannot make it and I'll pin it to my page. Thank you guys for the follow. Freddie Black, God bless you too. Me, yes, absolutely. Nigerian. Dan at Frey, you're very welcome. Thank you for the follow, Mistaken Identity. Freddie Black, thank you. Shitty, you're very, very welcome. I'm glad that you were able to get information. Yellow Elephant, you are absolutely welcome. There are new comments. I'll get to them. I'm just scrolling backwards, guys. See if there's anybody. So, Lord, okay, don't worry. IC Markets is regulated and has been there for a while. It's not regulated by FCA. It's regulated by... I'm not about to do that Googling for you, but I would not be recommending. Please give me some fucking credit, bro. I've been at this 10 years. Who be this? Shift Joe. Let me see. Okay, let's come to the new comments. Emma Wayne, I am very happy to have helped you. Resilience, can I say the link again? Hey, Resilience, did you send me a DM? Okwifo. This is what I've been talking about. Was the baby necessary? Spotware, SPOTWARE.com. Where do I recommend for beginners? Okay, baby pips. Okay, that's what you were saying, baby. Dim nanovex. I can't do wonder. BABYPIPS.com. I blame all those other people that have been sending me rubbish. All right, what do we got? What do we got? What do we got? What do we got? Now's your chance to ask questions. I'm about to take off. I'm about to take off. Thank you guys for the likes. Thank you for the follows. Thank you. I appreciate you. Thank you. Thank you. But more importantly, I'll appreciate you even more if you go back and look at your charts, please. Go back and look at your charts. It's not a strategy I'm teaching per se, it's a concept. So there's something I keep saying is whatever strategy you use to trade, whether it's break and retest, trendline breaks, I don't know, Malaysian SNR, whatever it is, I'm just talking about liquidity. So you can use the concept of liquidity to get you better entries, better exits, and get you out of losing trades quickly. Zoom up, you're very welcome. I'm pretty sure some of you have recorded, so if you're in the group, you can go ahead and share it for others for the benefit of those who couldn't make it here. I appreciate that. Alrighty. Thanks for the follows, e-trendings. Okay. Yeah, resilient. I see you. I apologize, man. I apologize. It's getting traumatizing at this point. If I show you my inbox, it's not even funny. It's not funny at all. So I thought I was dealing with another situation. But no, it's not PX. It's baby PIPS. Letter S. S for snake. S for snake. Sharksy Pappy. I'm going to be live. I need you guys to bring this light back, Joe. I'm going to be live weekends. And every time it's weekends, we talk psychology. Okay? We talk psychology. Can you run through a little, ma'am, about concepts? I'm late in. Oh man, I'm so sorry. We're actually at the end here. So anytime you see me actively addressing the comments, that means we're in the end. And but you can show up tomorrow though. Tomorrow is the last chart analysis type thing that we're gonna do, and then from Saturday, Sunday, it's gonna be psychology. Okay. So Sharksy Papi, I hope I'm pronouncing that right. Sharksy Papier. I'm not sure. Let me know. But anyway, yeah, there's gonna be. Thank you for the follow as well. We'll talk about psychology. Yeah, I know, right? Especially when you try to offer free service. Exactly. Resilient, thank you. You understand where I'm coming from. You understand. Some people just, they ruin it for others. Yes, totally an IV pump. I'm about to die. Nah, it's the, what do you call it? UPS. The power went out, but it's about to come back on, so. And it's back. All right, so I'm not getting any questions. J8, please show up 11 p.m. UTC plus one, okay? That's Nigerian time. So if you're not from Nigeria, just try to make that conversion and show up. I'm always here unless I say I'm not. Okay, seems like that's about it. You're in Philippines. Okay, awesome, awesome. So just check what time it is for you right now. For me, it is 12:38 a.m. So check it out. Oh, resilient, thank you. I appreciate you. Thanks for the follow. Thank you. Thanks, guys. All right, so I see there's no further questions. True, God bless you too. No further questions. I'm doing this for free. If anybody's charging you, you don't have to pay. I'm telling you this right now. Why am I doing this? What's the catch? There's no catch. There's no catch. I've come with my hands open like this. And I've told you the only thing you will see about charging is a one-on-one mentorship, which is different. The reason I'm charging for that is because you're demanding my time, my personal attention. You will get my full, complete attention. We will talk about your personal issues. We will work through them, analyze your trades. That's going to take time that I am not offering for free. I already am offering an hour plus every day, which is more than enough. Trust me, more than enough. I just put that option there because let's be real, you will never ever be able to guilt me into saying, no, but a true mentor should not charge. First of all, I never call myself a mentor. Generally, I become a mentor if you pay me for it. Right now, what I see myself as is a teacher. I teach for free. This is a spiritual calling for me. That's what it is. Sounds silly to some of you, but it's very spiritual to me. This has been my life. I got depressed. I cannot count the number of times I almost offed myself because of this. And so the minute I figured it out, I said, I'm going to give back. You sign up for the one-on-one, you join my Telegram, there's a pinned message about it. And if you can't afford it, it's okay. I promise you, just keep coming to the lives. It's all you need. Just that if you want to move faster, a one-on-one will help you. But if you just come for the lives, it's all you need. It's all you need. What other questions were there? No, I didn't miss anything. I think that's about it. Too late to buy XRP. So the only thing I feel about XRP is I'm very, very sad that I sold all 4,000 of them before I could have capitalized. Otherwise, I can't tell you shit. Just look at the charts for yourself and analyze. But also, you have to pay attention to the fundamentals. I do know that one thing about XRP is the transactions are lightning fast compared to other cryptocurrencies, and also stupidly cheap. So something that fast and that cheap is definitely worth looking into and could possibly be worth a lot more in the coming years. This is not financial advice. Take it at your own risk. Resilient, I'm not in Europe. I'm very Nigerian and very much in Nigeria. JH, you're welcome. You're welcome. So Luke Stafford, I hope that answers your question. Sierra Pajarilo, you okay with one-on-one with a total beginner? Oh, damn. Ooh, that is something to think about. Tell you what, why don't you join the Telegram group? Give me your actual, let me, how do I put this? Join the Telegram group and message me directly. You have permission, because in the group I have rules. Nobody message me directly unless I say it's okay. Go ahead and message me directly. Let's talk about it. I need to know how much of a beginner you are, like a serious beginner. And I also need to know if you are actually serious, because I'm not interested in taking money if you're not serious. I'm not interested in it. I don't need it. So I'm very particular. Actually, the mentorship is for those who, like me, know a lot about trading. They've just not been able to crack it because of their mental. We can talk about charts. We'll also be talking about mental game. So I need to know where exactly you are before I say yes to that. Because some people, and this is no shade to you, it's just a general observation. Some people think they want to learn how to trade because they've seen the screenshots, they've seen the lifestyle. And then when it really gets down to it, they're like, yeah, nah, this is not for me, So we need to talk about whether you're okay with the idea of losing, for instance, because I don't preach certainty. What pair is this? This is AUD USD M15. Sierra Pajarilo. Okay? Are you from, that's you, right? You're not, this is not someone pretending. There's so many accounts there. You just know that's not exactly who the person is. But yeah. ¿Hablas español? Let me know. ¿Tú hablas español? Resilience, I don't do WhatsApp. I've never liked that platform for anything. Telegram. It's in my bio. The link is in my bio. Voiceless 240. The link is in my bio. You're from the Philippines. Oh, yeah. All right, cool. Cool. Yeah, I figured. Once you said Philippines, I forgot. My bad. Okay, I think that's about it. So yeah, message me. Those of you who are looking for mentorship, please don't message me if you're not serious. Don't message me if you're not going to commit. There's two options. There's a 2-week option. There's a 4-week option. I have exactly 5 slots. I'm actually considering cutting it down to 4 because I have shit to do, to be real. So that's up to you. Okay, guys, I'm going to take off now. I'm pretty sure that something I've shared here has helped you. If you came late, just come here tomorrow, 11 p.m. UTC +1, West African time. There's no daylight savings. It's always 11 p.m. So do the conversion right now. For me, it's 12:44 a.m. So check what time it is for you. Do the math. I will be here 11 p.m. tomorrow for my time. Okay, guys, thank you very much for the follows, the likes, your time, your attention. Please remember, go back home and study. Don't just take my word for it. And I hope you have a wonderful day, a wonderful trading day on Friday. May the pips be with you.